Advisory firm PwC released the annual Global CEO survey at the ongoing World Economic Forum in Davos on Monday. The survey suggested that while Indian CEOs were a tad bit optimistic about the country's growth in the face of global headwinds, their global peers were not that positive. Nearly 6 out of 10 corporate heads in India were optimistic about the country's growth prospects in 2023, the survey said. But at the same time, the report also said that the responses by Indian CEOs marked a dramatic shift from the mood in 2021, when 99% had said that the country's economic growth would improve over the next 12 months. The firm said that it was the most cautious outlook in over a decade. About 41% of Indian CEOs believe that their organizations will not be economically viable in 10 years if they continue on their current course. Climate change has also gained prominence as a cause of concern over the next 5 years, with 31% of Indian CEOs saying that their companies will be highly exposed to it. The survey found that compared to Indian CEOs, only 37% of Asia-Pacific CEOs and 29% of global CEOs expected economic growth to improve in their countries or regions over the next 12 months. The survey was conducted in the last quarter of 2022. About 4,400 CEOs from over 100 countries, including 68 from India, participated in it. A mix of both positive and negative domestic and global factors may be driving the cautious sentiment among India Inc.'s leaders. First, there is a broad consensus that North America and Europe will see a recession this year. The PwC survey also showed that 78% of CEOs in India and 73% of global CEOs believe that global economic growth would decline over the next 12 months. According to PwC, this is the most pessimistic that the CEOs have been in over 12 years. Recession fears in developed economies have led to a slowdown in external demand, which is already affecting India's outbound shipments. The country's merchandise exports contracted over 12% year-on-year in December to about $34.5 billion. Additionally, China's opening up may help the global economy, but its economy slowed sharply in the fourth quarter, dragging down 2022 growth to one of its worst in nearly half a century. There is also uncertainty around how Beijing will deal with the growing number of COVID-19 infections. Back home in India, inflation had remained above the central bank's upper tolerance band for most of 2022, but there has been respite on that front. In December, CPI-based inflation eased marginally to 5.7%, staying within the Reserve Bank of India's tolerance range of 2 to 6%. In November, CPI was at an 11-month low of 5.88%. But RBI Governor Shaktikanta Das has also repeatedly emphasized the importance of bringing down elevated core inflation. There are also apprehensions that the rising prices of non-perishable items may not allow food inflation to cool soon. Overall, India Inc. may be worried that the pandemic-induced pent-up demand that propped up consumption in 2022 despite inflation may not continue in 2023. The first advanced estimates of GDP for FY23 have shown that consumption is expected to show a strong recovery as the economy bounces back from 2 years of the COVID pandemic. In nominal terms, private final consumption expenditure, which is a proxy for household consumption, is expected to rise to 164 trillion rupees in FY23, up from 140.9 trillion in FY22 and 120.3 trillion in FY21. However, analysts have said that the current consumption demand is highly skewed in favor of goods and services consumed by households falling in the upper income bracket. Thus, they have warned that a broad-based consumption recovery is still some distance away. Economists have also warned that most of the improvement in private final consumption expenditure came due to pent-up demand in the first half of the year, and that a slowdown was being seen in the second half. They added that this slowdown would continue in FY24, even though India would avoid a recession. Ultimately, this could be the factor behind India Inc. leaders adopting a cautious outlook.
They know that consumption, which accounts for 60% of aggregate demand, which is GDP, has only barely crossed the 1920 level. In per capita terms, it would have just barely crossed it. And please remember, when we say per capita, that's the national average. And we know perfectly well that the distribution of income and hence consumption has been worsening because unemployment has been at a historic high in the recent past.
Internationally, the world is now going through a very turbulent phase. The world markets are fragmenting, protectionism is on the rise, investment climate is worsening. The Ukraine-Russia conflict has also worsened the same situation. And then the Chinese economy now being hit with the COVID, etc., means that the demand is lower. So all these uncertainties on the global stage is the cause for that caution, which I think is quite well understood. On the domestic front, the caution is exercised because rural consumption doesn't seem to have strengthened as much as it could have.
In the lead up to the budget, top industry bodies have called for rationalizing personal tax rates in a bid to increase broad-based consumption. Apart from that, what more can be done to improve India Inc.'s outlook?
Well, the first and most important thing that it could and should do is to cut the indirect taxes on petrol, diesel, and gas, because that is an input into so many commodities which has been driving inflation. Joblessness is so high that even low rates of inflation are impacting the vast majority of the population. The second thing that I'm expecting the government to do in the budget is to, like last year, provide for state-level capital expenditure. The reason why they should provide it to state governments is because the nature of their capex, of their infrastructure expenditure, is such that it generates more jobs because it's less capital intensive.
Well, within the budget, what the government could do is to try and allocate a larger sums for agriculture investment, and also encourage banks to lend, increase their priority sector lending to the small and medium enterprises, to the agricultural sector and to the exporting sector, so that the demand there goes up. The second part would be, of course, that the government can continue with its pro-capital expenditure policy.
The government has been pushing up public investment to crowd in private investment, but not with much success. While enabling factors like capacity utilization and bank and corporate balance sheets have improved, job creation may prove to be the missing ingredient that could improve India Inc.'s growth outlook and lead to an investment revival.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.